Well, the RBA cuts the cash rate to 3.6%, shaving $300 a month off a $600,000 mortgage. Bond markets bet on 2 more rate cuts this year if inflation behaves. And the big portal headlines, it's a seller's spring and a buying boom. Now, Domain, a 60% clearance rate equals balance. A 70% plus equals rapid price growth. But the final clearance rate at 52.6% means buyers are still in the box seat. Well, g'day, folks. It is Matt Hayson here. This was one of the most anticipated rate cut calls in many years after the false start in July. Now, the RBA, as we know, took the cash rate down to 3.6% this week. That's around $300 a month off a typical $600,000 mortgage. Now, that's helpful, but most households will see that swallowed up by everyday costs. Now, the bond markets, they are expecting 2 more rate cuts this year, but as long as inflation stays tame. So the big question, what happens next? Well, the portals were at the ready. Domain's headline was pretty interesting. The good news for home sellers this spring and the bad news for buyers. Now, REA weren't much different. A rate cut could trigger a buying boom. And sure, these are really big headlines that sell clicks, but remind me again where these two make most of their money, because Domain's article leaned very much into a climbing preliminary clearance rate in Sydney, sitting at 68.2% last week. They also state their yardstick very clearly that a 60% market, according to Domain, in the clearance rate equals balance. 70% plus tends to bring rapid price growth. So let's hold that thought though, because the final clearance rate in Sydney was sitting at 52.6%. So by Domain's own definition, that's not a balanced market, it's a market favouring buyers. And our volumes remain low as well, 775 auctions last week. By mid-September, we expect that number to jump to 1,400. So that's when the real test of the depth will be, when stock really doubles. We know now the price tape for Sydney, it's just up by a modest 1.6% year to date. So it's not exactly moonshot territory. So the same day as the rate cut, the bank dropped a brutal reality, and the RBA issues a shock warning of a poorer Australia as it cuts rates. Now, key points were productivity growth in Australia has been cut to 0.7%. Sustainable wage growth has been capped near 3.2%. The long run growth potential for Australia is just 2% a year, and about 70% of our GDP growth is by population growth, not through productivity. Now, our living standards are worse than our parents and grandparents. So in plain English, our lower pay growth, weaker spending, softer profits, and a handbrake on living standards, which leads us into next week's productivity roundtable, which I mentioned last week. And on the menu is tax reform, fiscal, sustainability, approvals, competition, and AI. Meanwhile, Victoria is pushing 2 mandatory work from home days, and there's even chatter of a 4-day work week. Honestly, Australia, we do need to lift. We've also got a PM that says no new taxes before the election, but we'll take that under advisement, as we know Polly promises can be short-lived. Now, this property cycle isn't really a straight line. Rates down automatically doesn't mean that prices boom. With the economy stuck in low gear, I still think we need another rate cut before we really see that dial turning. Now, there is some good news though. 20 lenders now have mortgage rates under 5%. The Bank of Queensland, the best of those, at a 4.89 fixed rate for 2 years. Now, pre-approvals, they are also up, and confidence will pop. So just a reminder though, supply is about to double. So this week, we land the CH mood meter at a 7 out of 10. There is optimism with a firm grip on reality. So that's a wrap for this week. Plenty going on as always, including some amazing properties that we're opening for inspection this weekend. And I look forward to catching you all next week.